Here are the worst tax mistakes I've seen as a CPA, ranking from you're a little screwed to you're very screwed. Number 1, not making estimated tax payments, particularly on income where taxes are not automatically withheld like your salary. Now, the most common one that people think about is self-employment income, but other income that gets missed all the time is interest income on high-yield savings accounts, especially applicable now with interest rates being as high as they've been over the past couple of years. Crypto or investment gains. It's not as easy to hide this as it used to be, since many crypto trading platforms are now starting to issue 1099s, which do get filed with the IRS. And then gambling winnings. You may be able to hide this income from your spouse, but DraftKings and similar platforms will report this income to the IRS if it's over $600 in a year. The penalty for being late on your taxes is 0.5% per month on the unpaid tax, up to a maximum of 25%. And then you also have interest on the late tax, so they kind of get you from both ends, and that is the Fed short-term interest rate plus 3%, and that compounds daily until the balance is fully paid. So a quick example, if you owe $10,000 and it's 6 months late, you'd pay about $300 in penalties and about $350 in interest. Now, you can avoid this by doing quarterly tax projections and paying quarterly tax estimates as needed. Number 2, late filing or not filing your taxes at all. Now, the penalty for this is a bit more severe. It's 5% of the unpaid tax per month for every month that you're late. So if you owe $10,000 and you file your return and it's 3 months late, the penalty on that would be $1,500. So if you let this go, this can add up pretty quickly. If you can't get your return filed by April 15th, just file a 6-month extension. That'll help you avoid the failure to file penalty for 6 months at least. And no, an extension does not increase your risk of an audit. But what is even worse than this is the failure to file penalty for the new BOI reporting requirement, which is new this year. It's not an IRS filing, it's a FinCEN filing, but it is required if you have an LLC. The penalty for not filing is $591 per day. I'll put a link in the description on how to complete. Fortunately, it's very easy, but so many people are unaware of this, and the penalties for not filing are pretty severe. Number 3, selling your home too early. If you sell your primary residence before living there for at least 2 years, you could owe a pretty big tax on the gains. Whereas if you live in that house for at least 2 of the last 5 years, those gains can be excluded from your taxes up to $250,000 if you're single, or $500,000 if you're married. So if you have some control over when you need to move, don't disregard the huge benefit of waiting till you hit that 2-year mark. Number 4, selling your investments too early. If you sell your investments after holding them for 1 year or less, you pay a higher tax rate on those gains. This is called short-term capital gains. Versus if you held those investments for longer than 1 year, you get a tax discount through the lower long-term capital gains rates. Now, disclaimer here, you probably shouldn't make investment decisions purely based on taxes. There may be reasons to sell it before 1 year, but it just is something to keep in mind. Number 5, incorrectly reporting restricted stock units on your tax return. This is niche, but it is important. If you receive restricted stock units from your employer, you get taxed on those when they vest. It shows up on your pay stub normally and definitely on your W-2 at the end of the year, and they usually withhold taxes on that. That's not the issue. The issue is when you go to sell those stocks. It's not uncommon for the custodian to report a basis of 0 on the sale on your 1099. Meaning if you were to just report the stock sale as it's shown on the 1099, you could pay tax on the entire value of the stock instead of only paying taxes on the gains. Your basis is not 0. Your basis is the value of the shares at the day of vesting. Fortunately, it's an easy fix. If you've already made this mistake, you can go back, amend your prior year return, and hopefully get some money back. Number 6, withdrawing from retirement accounts too early. Unless you meet one of the exceptions, withdrawing from a retirement account before age 59 and a half will result in income and likely a 10% early withdrawal penalty. This is understandably one of the first places that people go when they need a large sum of money to buy a house or a property or to start a business, but it's not always the best or the only option. If you need this money for real estate, a lot of 401k plans will allow you to borrow against your balance without triggering taxes or penalties, as long as you follow the repayment terms. If you need this money to fund a business, you can actually use retirement funds to start a business without penalties or taxes. It's a more complex strategy, but it is possible. Now, if you've already withdrawn funds and you realize it wasn't the best move, you do have a limited 60-day window to redeposit the money into the retirement account and avoid taxes and penalties. Just make sure to explore all of your options before withdrawing from retirement accounts. Number 7, Roth conversion at the wrong time. Now, Roth conversions can be a great strategy. We use them all the time, but they don't make sense for everyone or at every stage of life. With these, timing is everything. A poorly timed Roth conversion could have some pretty significant tax consequences. The conversion itself is taxable, which could push you up into a higher tax bracket. And if you're older, that higher income could increase your Medicare premiums, and those aren't necessarily unsubstantial. Business owners might lose their QBI deduction, the qualified business income deduction, due to the income boost from the conversion. You could also become subject to the net investment income tax or other surtaxes due to the extra income. It's not just about your federal tax rate. There are many factors to consider before executing a Roth conversion. So crunch the numbers before attempting that. Number 8, buying something purely for the tax deduction. This is objectively a net loss. Here's why. Let's say you're in the 24% tax bracket. For every dollar you spend, you're only saving 24 cents in taxes, meaning you're still out 76 cents for every dollar. It's not saving you money. You're still out more money than you would be had you just paid the tax. Think of it this way. If somebody offered you a 24% discount on something that you don't even want or need, would you jump at that chance? Probably not. And a tax deduction is really no different. Now, if you genuinely need or want that item, then great, go for it. But just don't let the idea of a tax deduction trick you into wasting money. Number 9, failing to keep track of basis. Your basis is essentially what you've invested in an asset, like real estate or a business. And there are certain situations where this can have significant tax implications. For example, let's say you buy a rental property for $200,000. You put 50,000 renovations into it. Now your basis is 250,000. Now, if you don't report those renovations and add them to your basis, then you're going to end up paying a higher gain when you go to sell the property. Now, in a business situation, contributions and earnings increase your basis. So if you lose track of those, you might actually end up paying taxes on distributions that should have been tax-free. Good accounting and bookkeeping can help you with this. Number 10. Not doing a 1031 exchange. When you sell an investment property, gains are subject to capital gains tax and possibly depreciation recapture. But with a 1031 exchange, you can defer those taxes by rolling the proceeds into another investment property. For example, if you sell a rental property for a $100,000 gain, you could owe up to $20,000 or more in taxes depending on your situation. A 1031 exchange lets you reinvest that full $100,000 into another property, keeping your money working for you instead of writing a check to the IRS. I've seen a lot of people miss this option and it leaves a lot of money on the table. Finally, number 11, using the wrong entity structure. You hear about the benefits of an S-Corp plastered all over social media, but using the wrong entity structure can actually create some pretty serious tax problems. For example, putting real estate in an S-Corp is usually a disaster. If you want to transfer property outside of the S-Corp, it's considered a taxable event, and that makes strategies like a 1031 exchange nearly impossible. Plus, your heirs don't get a step up in basis for assets that are held in the S-Corp, which means more taxes for them later on. Now, outside of real estate, electing S-Corp status too early can be costly. You may not even save enough in taxes to justify the additional fees for payroll and tax prep. On the other hand, waiting too long to make an S-Corp election could result in paying more taxes than necessary. The timing of the business structure really is crucial. And if you get it wrong, the consequences can be pretty expensive. Now, a good CPA should be able to help you with all these. You can book a call with our team if you need help with tax strategy. Otherwise, if you're DIYing it, just keep all of these things in mind.